Bismillahirrahmanirrahim. This is the first video on acquisition cost of unproved property under successful efforts method, and we are going to explain acquisition cost and the different types of acquisition cost. We will also explain how acquisition cost of unproved property are recorded under successful effort methods, and finally we are going to explain how the different types of acquisition cost are recorded under successful efforts method. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below, and for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on acquisition cost of unproved property under successful efforts method. Let us start with explaining the concept of acquisition cost. Acquiring rights in the mineral interest through leasing is complicated, especially if the mineral rights on a property are not owned by the surface owner. Company wishing to lease the property must first secure the rights from the subsurface owner and then second, the surface owner. The surface owner is entitled to receive payment for damages to the surface resulting from the exploration activities. However, the surface owner cannot deny the exploration company access to the land above the leased minerals. Companies operating in foreign countries must acquire mineral interest by contracting with the local government. And next, let us talk about what is acquisition cost. So, the acquisition costs are the cost incurred in acquiring an economic interest in the minerals rights, whether through leasing or by purchase. The figure gives an overview of the accounting for acquisition cost. Acquisition costs are capitalized under successful efforts method. The most significant acquisition cost is the lease bonuses, and a lease bonus is paid by the lessee to the mineral rights owner at the time the working interest is acquired through a lease agreement. Then there are other acquisition costs that are relatively insignificant, such as brokers' fees, legal cost, and options to lease or may also be incurred at the time of acquisition. Broker fees are the fees that are paid to real estate agents or to the landman for service in connection with leasing or purchasing property. These services include finding available property, negotiating, and consummating a lease or purchase. Legal fees are paid to attorneys who prepare the legal documents. Attorneys also ensure that the seller or the lessor has good marketable title. Just keep one thing in mind, that acquisition costs are capitalized and are debited to unproved property. So let us solve an exercise now. Lucky Company acquired a 500-acre unproved property. Acquisition costs include a lease bonus of 40 per acre and recording fees of 1000. So they are acquiring a unproved property. So unproved property is debit. And this is going to be debit by how much? 500 times 40 plus 1000, that makes 20 plus 1, that is 21,000. So unproved property is debit by 21,000 and we are paying cash, so cash is credit by 21,000. Just make a note that a proof property may also be acquired, and if a proof property is acquired, then obviously proof property will be debit instead of unproved property. Acquisition cost of proof property includes the cost that we have just now talked about, and they are going to be capitalized whenever they are incurred. They are not going to be expensed. Let us look into one more example on acquisition cost, or another example. Cost of 200,000 were incurred by Davidson Oil Company, Internal Land Department in acquiring leases. Of the 1 million acres of prospects, only 420,000 acres were leased. How much, if any, of the 200,000 incurred by the land department should be capitalized? So we have leased 420,000 out of 1 million, and the cost incurred for this is 200,000. So the amount to be capitalized will be 84,000. If capitalized, what account should be debited? Just keep in mind that when we are acquiring a unproved property, we are going to debit unproved property in this case. Now, it may look like accounting of acquisition cost is very straightforward. However, not all acquisition cost calculations are that straightforward. And for that, first of all, let us look into the different types of acquisition cost. So we have the 5 different types of acquisition cost. We have purchase in fees, internal cost, options to purchase or lease, delinquent taxes and mortgage payments, and top leasing. So we are going to talk about each one of them and also see how the journal entries are going to be recorded. Now, when land is purchased in fee, the purchase price must be allocated between the mineral and the surface rights acquired, and both the cost will be capitalized when they are purchased. The allocation of the total purchase price is based on the relative fair market value. The cost allocated to the mineral rights will be subject to amortization if production is achieved from the property. If the fair market value of only one interest is available, that is, we have only one and not both of them, mineral and surface, then that interest will be allocated an amount equal to its fair market value, and the remainder of the payment allocated to the other interest. Let us look into an example when the fair market value is known for both, that is the mineral rights and the surface rights. So Lucky Company purchased land in fee for 40,000. A qualified appraiser made the following estimate of the fair market value of the mineral and surface right. We have mineral rights and we have the surface rights. So the 40,000 of the acquisition cost would be allocated as follows. We are going to calculate for the land, and the land surface rights are 30,000 divided by 50, the total fair market value, times the cost we have paid, that is 40,000. So this is equal to 24,000. And for the unproved mineral rights, we have 20,000 divided by the total, that is 50 times 40,000. So this is equal to 16,000, and that's how we get the allocate the cost between minerals and surface rights. And the journal entry will be land is going to be debit for 24,000 and unproved property for the mineral rights is debit by 16,000 and cash is credit by 40,000. Let us look into another example of purchase in fee where the fair market value of only one is known. So Lucky Company purchased land in fee for 40,000. A qualified appraiser estimated the fair market value of the surface rights only to be 30,000. A reasonable estimate of the fair market value of the mineral rights was not possible. The 40,000 acquisition cost will be allocated as follows. Now, if the fair market value of only one interest is available, then that interest will be allocated at its fair market value, and in our case we know about the fair market value of the surface rights. The remainder of the payment allocated to will be allocated to the other interest, and obviously that is going to be the unproved property. So land, the surface rights are for, they are the surface rights and we know the fair market value, that is 30,000, and the unproved mineral rights will be 40 minus 30, that is 10,000, and the journal entry will be land debit by 30,000, unproved property will be debit by 10,000 and cash will be credit by 40,000. Let us look into another illustration where the fair market value of both surface rights and mineral rights are given. Now, Tharp Energy purchased land in fee for 100,000. The fair market value of the surface and the mineral rights were determined by a qualified appraiser. And you see in this case, we know the fair market value for both. And we have to prepare the journal entry. So first of all, we are going to calculate the surface rights. And this will be equal to 80,000 divided by the total, that is 120,000, and multiply by the fees we have paid 100,000, that is 66,667. And for mineral rights, we will be having 40,000 divided by 120,000 times 100,000, and that is equal to 33,333. So the surface rights, that is land, is debit by 66,667. Unproved property is debit by 33,333 and cash is credit by 100,000. Let us do one more exercise on purchase in fees when the fair market value of only one is given to us. So now Bruce Corporation purchased land in fees for 610,000. The land was located in a remote area in Wyoming. An appraisal estimated the fair market value of the surface rights to be 400. The appraiser was not able to make an estimate of the value of the mineral rights, and we have to make the general entry for the purchase. So we have the surface rights, and for the surface rights we know the fair market value, and that is what is the fair that is 400,000, and the mineral rights will be 610,000 minus 400, that is equal to 210,000, and you can see that the total is 610,000. So the general entry will be land will be debit by 400,000, unproved property is debit by 210,000, and cash is credit by 610,000. So we have talked about the purchase in fees, and we go on to talk about the second acquisition cost, that is the internal cost. Okay. Now the internal cost are the overhead costs related to lease acquisition, and the internal costs are also capitalized, and they include payments to in-house lawyers and landmen, etc. They are often as these lawyers or landmen are involved in multiple activities including acquisition of mineral rights, examination of records before drilling is commenced, and negotiation and arrangement of joint ventures, etc. So directly allocating these type of costs to specific leases may be impractical if the costs are insignificant. However, if the costs are material, then they should be allocated to individual properties, and there are two reasonable bases are there. One is capitalize the portion of the cost relating to acquisition activities and allocate to individual leases acquired based on total acreage acquired. And the second is to allocate the portion of the cost relating to the acquisition activities on an acreage basis to all prospects investigated, capitalizing the portion of the cost allocated to prospects acquired, and expensing the portion of the cost allocated to prospects not acquired. So let us look into an example of internal cost to further simplify the concept. So Lucky Company acquired an 800-acre undeveloped lease at a 10 per dollar acre bonus. So we have a bonus now, and bonus is 800 times 10, that is 8,000. Legal cost, we have legal cost as well of 200, and then we have the salary, and this is what we have to calculate as far as the internal cost is concerned, because we have acquired a total of 800 undeveloped lease, and the lawyer salary is allocated to all leases acquired based on relative acreage acquired. During the accounting period, leases totaling 8,000 acres were acquired. So we are going to allocate proportionately. So 800 upon 8,000 times the salary paid, that is 10,000. So this is equal to 1,000 and the total will be 9,200. And the journal entry will be unproved property is debit, and this is debit by 9,200, and cash is credit by 9,200. Next, let us look into another acquisition cost, that is option to lease. Now, prior to the lease agreement, oil companies generally obtain shooting rights to a property to conduct G&G cost or G&G studies. Now, these shooting rights will be coupled with an option to lease, and this guarantees the oil company to keep the right to lease the property at a specified price and for a specified time period. Now, since the cost of an option to lease is an acquisition cost, so it should be temporarily capitalized in a suspense account until a decision is made about whether to lease the property or not. And once the property is leased, the option cost should be capitalized as part of the unproved property. If the property is not leased, the option cost should be expensed. Please keep in mind that the shooting right are the G&G exploration cost and should be expensed, and G&G costs are not the acquisition cost over here. So, while dealing with shooting rights coupled with an option to lease, the payment involves the acquisition cost as well as the exploration cost. Now, if the whole acreage is leased, then the entire payment is capitalized as an acquisition cost of the property. If none of the acreage is leased, then the option to lease amount should be expensed as G&G exploration cost. If a portion of the acreage explored is leased, then the cost of option to lease is apportioned based on the relative acres leased. That is, if the company leases 70% of the land, then 70% of the cost will be capitalized as an acquisition cost of the property, while the remaining will be expensed. So let us look into an example of an option to lease. Lucky Company obtained the following rights: shooting rights only for 2 per acre on 3,000 acres owned by Mr. A. Now they are acquiring shooting rights, and shooting rights are the are the are the exploration expense. So we have G&G expense, as they are expense and not capitalized. So 2 times 3,000 G&G expense will be debit by 6,000, and we are paying cash, so cash is credited by 6,000. Then the shooting rights coupled with an option to lease for 15,000 on 3,000 acres owned by Mr. B. Now these 3,000 acres are located adjacent to 3,000 acres owned by Mr. A. So if we go for a theoretical journal entry, we are going to split it into G&G expense. So we are going to have G&G expense debit by 6,000 and property purchase suspense is debit by 9,000 and cash is credit by 15,000. However, as we know that the entire payment is going to be capitalized, so theoretically this may be right, but the actual journal entry will be purchase, uh, property purchase suspense is debit by 15,000 and cash is credit by 15,000. Then we have the third one, shooting rights coupled with an option to lease for 10,000. We have shooting rights with an option to lease for 10,000 on 1200 acres owned by Mr. C in Timbuktu. Lucky Company has no reasonable basis for valuing the shooting rights versus the option to lease. Now, since they don't have any basis, so they were having the basis, so we recorded it separately. We have added it, but then here we will simply straight away go to the purchase or rather sorry property purchase suspense is debit by 10,000 and cash is credit by 10,000. You can see that the whole cost has been capitalized. Now, as a result of the G&G work performed in A, B and C, Lucky Company made the following decisions, and the first decision is not to lease any of Mr. A's acres. So for Mr. A, that was we have paid and we are not going to lease this property, so we are not going to make any journal entry over here. Then for B, Lucky decide to capitalize that to lease only 1/3 of Mr. B's acres and they are paying a bonus of 20,000 as well. So first of all, we are going to have the surrendered lease expense. We are leasing only 1/3, that means it will be 2/3 of 9,000. 15 minus the shooting right 6, that is 9,000, so 2/3 of 9,000 and that will be 6,000. This will be debit by 6,000. And then we have unproved property and unproved property is 1/3 of 9,000 and they are paying a bonus of 20,000 as well, so that is equal to 3 and 23 is also debit by 23,000. And now we are going to close this property purchase suspense by crediting it. So property purchase suspense is credit by 9,000 and cash is credit by the balance amount, that is we have paid 20,000 of the bonus. Okay. Then in the case of C, to lease only 1/4 of Mr. C's acres and they are paying 15,000 for the bonus. So again we have the surrendered lease expense and since we are going to lease only 1/4, that means it will be 3/4 of the amount that was 10,000. So 3/4 of 10,000 will be debit and the amount will be 7,500. And unproved property, it is going to be 1/4 of 10,000 plus 15,000 is debit again, and that is 17,500. And the property purchase suspense is going to be closed out. So property purchase suspense is closed out, and this is credit by 10,000, and cash paid is 15,000. Okay. Next, let us solve another illustration on option to lease, and this is not top leasing, this is option to lease. Okay. Norton Energy decided to explore some acreage in Wyoming before acquiring any lease. Norton acquired shooting rights only on 10,000 acres owned by Mr. T for 1 per acre. So that is number 1. Okay. Norton obtained shooting rights. Okay, this is second. They have obtained shooting rights coupled with an option to lease on 15,000 acres owned by Mr. H for 0.25 acres. And after completing the G&G survey, that is number 3, at a cost of 92,000. Now, Norton decided to lease 1,000 acres from T, paying a bonus of 350 per acre. Norton also decided to lease 1,500 acres from H, paying the same bonus of 350 per acre. Norton income statement has seen better days, and although it will not help much, Norton decides to capitalize every possible cost. Okay. So first of all, we have to make the journal entries, and the first one will be when we are acquiring from Mr. T. And we are having only the shooting right. So again, this shooting right is G&G expense, and this is at the rate of 1 per acre for 10,000. So that is going to be 10,000 again. This will be debit by 10,000, and we are paying cash. So cash is credit by 10,000. So this will be the first journal entry. Now in the second one, they have obtained shooting rights coupled with an option to lease on 15,000 acres owned by Mr. H for 0.25. And since we do not know the shooting rights, so we straight away capitalize this, and this will be who is this? Mr. 1 minute. We go to number 2, and this is Mr. H. So we have Mr. H acres. So property purchase suspense is debit by 0.25 times 15,000, and this will be 3,750, and cash is credit by 3,750. Then we go to the third one. There was a G&G survey for 92,000. So G&G survey, and G&G survey is an expense. So G&G expense is debit by 92,000, and we are paying cash, so cash is credit by 92,000. Then we have number 4. Norton decided to lease 1,000 acres from T, paying a bonus of 350 per acre. So they are paying a bonus of 350 per acre. So again, this is Mr. T's acres, and unproved property is debit, and that is 350 times 1,000, that is 350,000, and cash is credit by 350,000. Okay, then we go to the next one. Norton also also decide to lease 1,500 acres from Mr. H, paying the same bonus of 350 per acre. So here we are going to have two things. We have number 5, Mr. H acres. So unproved property, and this will be debit by 3,750. And 350 times plus, so 3,750 plus 350 times 1,500, so this will be equal to 528. 350 times 1,500 plus 3,750. This is debit, and this is debit by 528,750. And we are paying cash, so cash is credit by we are paying a bonus of 15, so this will be 525,000, and the property purchase suspense will be credited. Property purchase suspense will be credited by 3,750. Next, let us look into the fourth acquisition cost, that is the delinquent taxes and mortgage payments. Now, delinquent taxes means the cumulative amount of unpaid taxes, assessments, recoupment charges, penalties, and interest charged against eligible delinquent land that became delinquent before transfer of title to a county or a municipal corporation, etc. Now, during the initial process of obtaining a lease, the lessee, the oil company, may agree to pay such items as a lessor's delinquent taxes or mortgage payments in order to obtain a lease on land with a clear title. The lessee may or may not be able to recover such payment from future delay payments, or delay rental payments, or future royalty payments. Accounting treatment depends upon whether the payment are recoverable or not recoverable by the lessee. If non-recoverable, then the payments are additional cost of acquiring the property and should be capitalized as an acquisition cost. If recoverable, the payment should be held in a receivable or a suspense account until it is recovered. Now, it is possible that the lessee surrenders or abandons the lease, and in that case, the payment should be charged to surrendered lease expense. Now, payment of delinquent property tax by the lessee for the lessor is different from payment of property taxes. The property taxes are the property taxes assessed by the governmental body on the economic interest owned by the lessee and not the lessor, while the delinquent property taxes are unpaid taxes paid by the lessee but assessed on the interest owned by the lessor. So let us look into an illustration on delinquent taxes and mortgage payments. Lucky Company paid delinquent property taxes of 300 on an undeveloped lease as called for in the lease agreement. Assume these taxes were not recoverable, and if they are not recoverable, then the payments are additional cost of acquiring the property and should be capitalized. So we have unproved property is debit by 300 and cash is credit by 300. Now, since the taxes were part of the lease agreement are non-recoverable, so the payment is a acquisition cost. Okay. Now, assume that instead the taxes were recoverable out of the future delay rental payments or royalty payments. So, in this case, they are recoverable, and if they are recoverable, then this becomes a receivable from lessor. So, receivable from lessor is debit for 300 and cash is credit by 300. 2 months later, a delay rental of 400 was due. Now, since the 300 delinquent property tax paid by the Lucky Company is recoverable from the delay rental, a net payment of 100 is remitted. So, we are remitting 100 for that. So, we have delay rental, and delay rental is an expense. Is debit by 400. Receivable from lessor is credit by 300 and cash is credit by 100. Okay. Now assume that instead of making the delay rental payment, Lucky Company had abandoned the lease without recovering the delinquent property taxes. Remember that if the lessee surrenders or abandons the lease, then the payment should be charged to surrendered lease expense. So we have surrendered lease expense is debit and receivable from lessor is credit by 300. Let us look into one more illustration. And Gamma Petroleum made the following transactions A, B, C, D, E, and we have to make the entry to record these payments. Okay. Now, on March 10, 2017, Gamma Petroleum paid delinquent property taxes of 4,000 on an undeveloped lease. Assume that these taxes are recoverable out of the future delay rental or royalty payment. So this is recoverable, that means this is a receivable from the lessor. So receivable from lessor is debit and cash is credit by how much is this 4,000. Okay, we go to number B. On February 15, a delay rental payment of 1,000 is due. Determine the amount of cash actually paid and give the entry to record the payment. So this is a delay rental. So the general entry will be delay rental, delay rental expense is debit and receivable from lessor is credit by 1,000. Then we go to number C. On July 21, 2018, Gamma Petroleum decided to surrender the lease. Give the entry to record abandonment with respect to the delinquent property taxes. Ignore acquisition cost of the property. Now, obviously, if we are surrendering, then this is going to be surrendered lease expense is debit and receivable from lessor is credit, and this is going to be 3,000. Then we go to number D. Assume instead that the 4,000 payment of delinquent taxes was not recoverable and was made at the time Gamma Petroleum was acquiring the lease. Give the entry to record it. Now, this is going to be now unproved property is debit by 4,000 and cash is credit by 4,000. Then assume that the 4,000 payment was not recoverable and was made by Gamma Petroleum 6 months after acquiring the lease in order to protect Gamma's investment. Now this becomes delinquent cost. Delinquent tax expense exploration now is debit, and this is debit by 4,000 and cash is credit by 4,000. Now this cost is a cost of maintaining and retaining the property and not a cost of acquiring the property. As such, it is a non-drilling exploration cost. Finally, we are going to talk about the fifth acquisition cost, that is top leasing. A top lease is a new lease executed before expiration of termination of the existing lease. A top lease is usually sought when the current working interest owner wants to retain a property on which no drilling was done during the primary term. Such a situation is a two-party top lease. Sometimes a different working interest owner will negotiate a new lease prior to expiration of the primary term on the current lease, and this is called a three-party top lease. If the existing lease is still in effect when new lease is executed, the book value of the old lease plus the acquisition cost of the new lease will be capitalized as acquisition cost. However, if the existing lease terminates prior to the date on which a new lease is obtained, the book value of the old lease will be expensed and only it is going to be expensed and only the acquisition cost of the new lease will be capitalized. In case a different working interest owner signs a lease agreement with the mineral rights owner before the end of the primary term of an existing lease, the situation is no different from the acquisition of a new lease. Acquisition cost paid by the new lessee are capitalized. So let us look into an illustration again. Lucky Company has two unproved leases with the following cost. Lease A, 320 acres for 30,000, and lease B, 640 acres for 40,000. A new lease was executed on lease A by Lucky, the original lessee, prior to the termination of the old lease. The bonus paid for the new lease was let me make some correction. For the new lease it was, let us make it 50 per acre. Now, if the existing lease is still in effect when the new lease with the same working interest owner is executed, the book value of the old lease plus the acquisition cost of the new lease will be capitalized as acquisition cost. So, unproved property for lease A is 30,000 is going to be credit. We are paying 50 times 50 for how much? Okay, let me make this one 500 to make my calculations easy. So we have 30,000 plus 500 times 50, that is 25,000. So this is going to be unproved property lease A is debit by 30 plus 25, 30, 40, 55 is going to be debit by 55,000. Unproved property lease A is credit by 30,000 and cash is credit by 25,000. I simply repeat again that if the existing lease is still in effect when the new lease with the same working interest owner is executed, then the book value of the old lease plus the acquisition cost of the new lease will be capitalized as acquisition cost. Now lease B, you go to B, terminates on November 14 and a new lease was executed and become effective on November 5. Now you see it terminates on November 14 and the bonus paid was, let me make my calculations easy here. Again, this won't be 120, but let us make it 60. So first of all, we are going to have surrendered lease expense debit by 40,000 and unproved property lease B is credited by 40,000. This will be on November 14 and then we have January 15, sorry, November 15. On November 15 we have unproved property lease B debit, and this is debit by 60,000 and cash is credit by 40,000 times 60. This is going to, and let me make this easy, if not make it 1,000. So 60 times 1,000 will be 60,000. Okay. Let us look into one more illustration. And Charles Oil Incorporated capitalized the following costs relating to two unproved properties, lease C and lease D, 42 and 50. Charles Oil Incorporated negotiated a new lease on lease C. Immediately following the end of the primary term, the lease bonus was 150 per acre on the new lease. Before the end of the primary term, Charles also obtained a new lease on D. So there are two leases, lease C and lease D, at a lease bonus rate of 130 per acre. This lease was to take effect prior to the end of the primary lease. So first of all, we are having lease C, and in this case this is going to be because you are following the end of the, so we have surrendered lease expense C is debit by 42,000 and unproved property C is credit by 42,000. And then that lease at the end, they go for a new lease at the same 150 per acre for 600. So 150 times 600 from the 150, that will be 90,000. So unproved property lease C is debit by 90,000 and cash is credit by 90,000. Then we go for lease D, and this is prior to the end of the primary. So unproved property lease D is debit by 206,000, and then we have unproved property D is credit by 50,000, and cash we are paying 130, so 130 times 1200, so that will be 156,000. So cash is credited by 156,000. Okay, so this completes part 1 on acquisition cost of unproved property under successful effort methods. We have discussed the meaning of acquisition cost and the different types of acquisition cost under successful efforts method. We also explained how acquisition cost and its types are recorded under successful effort methods. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. And one last thing before I go, if you have any question for future topics or any feedback, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.